The market is crashing. Your portfolio is bleeding red, and every headline is telling you the world is ending. Most people in this moment do exactly the same thing. They panic, they sell, and they watch years of wealth building disappear in a matter of days. But there is a small group of traders who genuinely look forward to moments like this. Not because they got lucky, not because they predicted the crash, because they built strategies that are specifically designed to profit from falling markets and exploding fear. And the worse things get, the more money they make. Today, I am going to walk you through exactly how this works. 3 real strategies that turn market chaos into opportunity, from the safest and most straightforward to the most powerful and most demanding. By the end of this video, you will never look at a market crash the same way again. Why crashes create opportunity. Before we get into the strategies, you need to understand one thing about markets that most people never grasp. Fear is the most powerful force in financial markets. More powerful than fundamentals, more powerful than earnings, more powerful than economic data. When fear takes over, markets do not move rationally. They move emotionally, and emotional moves create the largest mispricings in the entire market cycle. There is a measure of this fear called the VIX, the Volatility Index. When markets are calm, the VIX sits around 15 to 20. When markets crash, it spikes, sometimes to 40, 50, even 80, during extreme events like 2008 and 2020. Every time the VIX spikes, something specific happens that creates enormous opportunity for the traders who know how to use it. Options premiums explode, insurance gets expensive, and the people selling that insurance, rather than buying it, get paid extraordinary amounts of money simply to take the other side of the panic. That is the core insight behind everything we are about to cover. Strategy 1. Short selling. The most direct way to make money when markets fall is short selling, and it is also the most misunderstood. When you short a stock, you borrow shares from your broker and sell them immediately at the current price. If the stock drops, you buy them back at the lower price, return them to the broker, and keep the difference. The lower the stock falls, the more you make. During the 2008 financial crisis, traders who shorted bank stocks made returns of 50, 60, sometimes over 90% as those stocks collapsed to near zero. Michael Burry, who we covered in a previous video, made $800 million by shorting mortgage-backed securities before the entire housing market collapsed. The risks are real, and they are unique. When you buy a stock, your maximum loss is 100%. The stock goes to zero, and you lose what you put in. When you short a stock, your maximum loss is theoretically unlimited, because a stock can keep rising forever. A short squeeze, where a heavily shorted stock suddenly spikes upward, can wipe out a short seller in hours. This is why short selling demands strict risk management. Defined stop losses, position sizing that limits your exposure, and a very clear thesis for why the stock is going down and when you expect it to happen. Strategy 2. Buying put options. If short selling feels too aggressive, buying put options gives you the same directional exposure with one critical difference. Your maximum loss is capped at exactly what you paid for the option. Nothing more. A put option gives you the right to sell a stock at a specific price, called the strike price, before a specific date. If the stock falls below your strike price, your put gains value. The further it falls, the more your put is worth. During the COVID crash in March 2020, traders who bought put options on the S&P 500 or on individual airline and hotel stocks saw returns of 300, 400, sometimes over 1,000% in a matter of weeks as those stocks collapsed. Catch is time decay. Every day that passes, your option loses a small amount of value, even if the stock doesn't move. Buy a put and have the stock go sideways for 2 months, and you can still lose most of your investment. Timing matters enormously with long options in a way it simply doesn't with stock ownership. This is why buying puts works best as a targeted bet around a specific catalyst, an earnings report, a macro event, a technical breakdown, rather than a general directional view held over months. Strategy 3. Selling options during panic. This is the strategy most people never discover, and in many ways it is the most powerful of the 3. When markets crash and the VIX explodes, options premiums inflate dramatically. The insurance gets expensive, and instead of buying that expensive insurance like everyone else is doing in a panic, you sell it. You sell a cash-secured put on a high-quality stock that has been dragged down in the general market sell-off, not because its business is broken, but because fear sold everything indiscriminately. You collect a premium that might be 3 or 4 times larger than it would be in a calm market. You set your strike price at a level where you're genuinely happy to own the stock if assigned. 2 things happen. If the stock recovers, which quality stocks in indiscriminate sell-offs historically do, your option expires worthless, and you keep the entire premium. If the stock keeps falling and you get assigned, you own a quality company at a price that already reflects significant fear and pessimism, with a premium collected on top that further reduces your cost basis. And here is where the hedge comes in. For a fraction of that premium, typically 20 to 30%, you buy a put at a lower strike price. This caps your maximum loss if the stock truly collapses. Your income drops slightly. Your protection increases dramatically. You're now running a defined risk strategy that generates its best returns precisely when everyone else is most afraid. This is not gambling. This is running an insurance business during the most profitable season of the year. The rules every strategy we covered today can destroy you if you ignore the rules that make them work. For short selling, always define your maximum loss before you enter. A stop loss is not optional. The traders who blow up shorting are always the ones who held through a short squeeze, telling themselves the fundamentals would win eventually. Sometimes they do, but your account might not survive long enough to find out. For buying puts, size your position so that losing the entire premium does not materially affect your portfolio. Treat the cost of the put like the cost of insurance. You hope it expires worthless, but you are glad it was there when you needed it. For selling options, only sell puts on stocks you genuinely want to own at prices you can genuinely afford. Never sell more contracts than you can handle assignment on. And always hedge, especially in volatile markets, where the unexpected is always one headline away. Market crashes are not disasters. They are the most concentrated period of opportunity in the entire market cycle. For the traders who prepared for them, short selling captures the direct move downward. Buying puts gives you leveraged exposure with defined risk. Selling options turns the fear itself into income. Most people spend their entire investing lives treating crashes as something to survive. The traders who build real wealth treat them as something to use. Now you know how.